Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
We are joined on the program now by Andrew Slimmon. I am Senior Portfolio Manager and Head of Applied Equity Advisors at Morgan Stanley. Andrew, great to have you back on the program. A lot of the selling that we've seen on Wall Street here and even elsewhere has been in addressing the concentration in mega cap names. And we've had some seasonal factors too, but I want to start off with a slightly different direction. The solid economic data that we just reported there, it dents one of the other bear talking points, a weakening economy. And it also kind of adds to the Citi Economic Surprises Index that has had a huge bounce in July. The economy is not really weakening, is it?
Well, it's slowing, but it's not breaking. And I think that's the key thing. And I think that's what is a big reason you're seeing a rotation in leadership is the market is coming around to believing that the Fed can cut, that inflation's come down, but they can cut, but they can do it at their speed. It's not a nervous cut. And in that environment, that's why I think you're seeing small caps working. I think that's why you're seeing cyclical stocks working and a rotation away from growth stocks because seemingly the Fed is getting what they want, a low inflation and a slowing but not breaking economy.
So are you seeing more of a rotation internally rather than any new money coming off the sideline?
I think there was quite a bit of money that came off the sidelines in early July, but I think this is more a rotation in the markets right now. Now, I'd caveat all this by saying most of the big mega caps tech stocks are yet to report. And I think they will remind investors, don't get too negative on us. Our businesses are very, very strong. So I think it's what we've learned in the last month is don't just own growth stocks. Don't just own mega cap tech stocks because they move together. And when the world decides they don't like them, you're going to go down, they all move together. So you have to have some balance in your portfolio for what's happened in the last couple of weeks.
So we've seen NVIDIA, Broadcom, and TSMC all pull back about 18% from intraday highs a couple of weeks ago. And the NASDAQ 100 itself is down about 9%. We've seen kind of a change basically in a lot of the momentum plays, like Eli Lilly, for instance, nothing to do with high technology, really, down 14% in 8 sessions. So momentum plays have been sort of turned on their head. But given these numbers, 18%, as I mentioned, and Lilly down 14%, is it almost time to say enough already?
Yes. Because a question that I would ask you is there any fundamental change in any of these businesses? Has any of these companies come out and said, hey, business is good? Yep. And so what I've learned in this, what I try to focus on in this business is what companies are doing well that have raised guidance, but for one reason or the other, Wall Street has fallen out of love on a short-term basis. I think that's where you make your most money.
You've got I'm sorry to interrupt you there. You've got a big convention in your town next month. Is politics beginning to become a factor at all in the way the market is kind of working through different scenarios here, different styles of thought?
Yeah, I think so, because if you think about it, once kind of President Trump looked like he was, pulling ahead when Joe Biden was suffering after the debate. Small cap, that was part of the process of small caps in some of the value areas, because I think he is perceived as good for those areas. But this past Monday, when it was apparent that Kamala Harris was going to take over being the Democrat candidate, you saw mega cap tech stocks actually rally because she is from San Francisco. She has ties to Silicon Valley. So I think there is movement back and forth as determined by who's leading in the polls. But having said all that, I worry because we get a lot of inquiry from our investors asking about, the election, presidential election. And I don't hear as much questions about the Fed policy. And so I think in general, people focus too much on elections and not enough on Fed policy. There's no proof really that Democrats or Republicans, the market does better under one or other. But it is pretty conclusive that, easier Fed policy is better for stocks.
Well, we had some comments from Bill Dudley and also Ian Shepherdson saying that the Fed is dangerously close to being behind the curve and they better act quickly. That doesn't seem to quite gel with the argument you laid out for us that the economy is cooling, but it's not really weakening fast.
Well, yeah, I read those comments, and I think that's one of the reasons why I think we're getting close to actually a bottom in this little short-term correction, because I think he's signaling that that the Fed's going to be, cutting rates. But if the economy was collapsing, okay, you would see the yield curve uninvert. You would see the 2-year yield plummet relative to the 10-year. The yield curve has started to uninvert somewhat, but it's not yet. And so I think, it is, I am of the belief, and I've listened to a few industrial conference calls now where they're saying, yes, some of our businesses are slowing, but not our government business. Don't lose sight of the fact that we have a lot of fiscal policy spending this year that is propping up the economy. So I am definitely in the camp of slowing, but not breaking. Andrew, but I think for Bill Dudley, I think he's just saying, okay, enough's enough. I think they can ease.
We talk a lot on this show about markets in Asia. How are you viewing opportunities offshore? Are you seeing anything right now that's compelling?
Well, very simple. What I start with is where's the best earnings revisions happening? It's happening in the U.S. and it's happening in Japan. It's not happening in China. It's certainly not happening in Europe. So those are areas first I want to focus on. But having said that, again, as I said before, anytime there is opportunities where stocks diverge from their fundamentals, I'm very interested. So a stock like Taiwan Semiconductor, some noise from politics, but boy, oh boy, their business is booming. So, I think there's specific ideas. I just wouldn't make a big regional bet.
Yeah, I see that you mentioned the luxury good makers troubling to a certain degree. They struggled with China. So we'll save that for another day. Andrew, thank you. Andrew Slimmon from Morgan Stanley.
Rebecca Walser. She is president of Walser Wealth Management, and she happens to be here in the Bloomberg Interactive Broker Studio in New York. Good of you to drop by. Thanks so much.
Thanks for having me.
Before we get into kind of the nuts and bolts, what's happening in markets, I'd like to know what you're hearing from clients right now. Are they worried about a lot of the volatility that we've been seeing in markets?
Yeah, I think anytime you see a 20% run up starting at the end of last year and you kind of see this beautiful number through March and then you start to hit the volatility, it's a little bit unnerving to anybody. But then you compound that with an election year, you compound that with the crazy things that have happened just in the last 10 days, Doug, and you really see people start to say, what is going on? Are we in some kind of sea change, world turnover? What is happening here? Of course, I have been much more macroeconomically focused for the last 2.5 years, and I've been definitely talking to clients about the global sea changes that are coming. So they're a lot more aware than I would say the average investor client because we're just so focused on it in our practice.
So the news hasn't really changed for companies like NVIDIA and Broadcom, but the theme has changed. Investors now are kind of doubting whether or not, companies will be able to monetize AI. Do you see it that way, or do you think that this is just a sort of healthy correction because we ran too far too fast?
I definitely think that we did have a little bit of a rational exuberance since the end of Q4 last year, but it is a monetization problem. Anytime you're on a new dynamic, a new frontier, especially technology, we have this perfect example with the .com. We knew it would be monetizable at some point, but pets.com that was worth $1 billion before it even had a way to check a dog bag out wasn't going to work. It's the same thing with the AI runway. There's so many applications, but how do we take it from industrial business to business, B2B, to actual B2C, and make it profitable for both the consumer to use and the business to produce? So that's really what we're seeing. And I think the market has been priced so perfectly that if you look at Google and you have a double beat, but you still see it losing and trading in after hours to the downside, or people saying why, it's because there was no real solid guidance on what AI is actually going to deliver in terms of revenue and profitability.
You mentioned the fact that we're dealing with an election year. Earlier in the show, we had a story on President Trump commenting on the dollar, calling it a big currency problem. One of the things that he highlighted, and Janet Yellen incidentally pushed back against this idea, is that a strong dollar is hurting U.S. export competitiveness. Does he have a point there, or is the dollar strength really the reflection of just the Fed trying to get inflation under control and strong American economy and inflows from around the world coming to the United States?
Well, I actually think it's both, right? We definitely had to strengthen the dollar to create it had to become too expensive so that we had less demand, we had less economic activity, so we could bring inflation, the heat of the market down. So that had to happen. But at the same time, look at our Japanese yen situation, and the interventions that we've had with them in just the last 8 weeks. That is a problem. This is a problem for our partners globally when they are bringing in and so tied intricately, their currency is so tied to the dollar. And we have, not to make the dollar political, I don't like talking about politics, but the rest of the world does, a lot of the rest of the world, I should clarify, does view that America did weaponize the dollar post-Russia invasion of Ukraine in March of 2022, and that has made a lot of things happen a lot faster than maybe they otherwise would have, meaning de-dollarization, the BRICS initiative, the Enbridge initiative with the Bank of International Settlements. These things that have come as a direct result from that action really is a sea change moment in the global world currencies.
So you're dealing with high net worth individuals, obviously to a certain degree. I'm curious about when we see something like Ford today down 18%. It sort of raises an eyebrow. I wonder whether or not the Wall Street is looking a little bit more like a casino in the past couple of weeks, or maybe you can even say, for the whole rally that we've seen. But do you feel comfortable? I mean, how do your clients respond to this kind of volatility in stock trading?
Yeah, I mean, I think that it's unnerving if you're just watching the tickers, right, and you don't understand what's going on. Our clients, I feel, I mean, maybe they should be speaking on their behalf, but I feel that they're a lot more, they expected this kind of volatility because I've been talking to them about the underlying, fundamentals and technicals, and that I don't see the strength that Wall Street has seen for the last, really the positive momentum I thought was going to be problematic just because it was so sector defined and if you put $1 into the S&P 500 right now, 29 cents of that dollar goes to the top 5 positions. If you look at the top 10 positions, it becomes 37 cents on the dollar. We've never seen this kinds of concentration. When you have this level of concentration, that means that these stocks have to be perfect. They can't have anything. Go ahead. Sorry.
Didn't Apple just soar right through the global financial crisis and build a business that was, legendary? That's a parallel, isn't it? It's a secular change is what AI is.
Yeah, you're absolutely right. And it will fundamentally change everything that we do, how we work, how we live, how we pay, how we do everything. It is the largest technological change in the history of time, and who knows what will come after. So yes, I totally agree, but there's always a gap from the runway to the application and the monetization, and so that's what we're going to experience, and that will take time, and unfortunately we don't have enough of a broad-based strength in the global economy to make AI carry the torch for us for, successfully without any kind of market problems, volatility, and I do think a pullback.
I want to drag you back into politics. Do you mind?
No, not at all.
President Trump proposing tariffs. 10%, and in some cases, something far greater than that, maybe 100%, and extending tax cuts if there is the opportunity to do so. A lot of the economists that we have spoken with point to those two problems, or issues, I should say, as new problems on the horizon. Do you agree with that?
Oh, gosh. I am more of a laissez-faire person, so I'm not usually a tariff person.
But you're a tax expert.
Yes. But that's exactly what I was going to say. I was like, when you see a Trump dealing with tariffs, you're really dealing with him countermeasuring the most favored nation status that China still enjoys from the World Trade Organization, even though they're really the second largest, or in some ways the largest economy in the world. So I think that that's a counterbalance to other things that really aren't technically fair and global financial arrangements. From a tax perspective, of course, I would love the least amount of taxes as possible, but the truth is this country has a massive debt problem, and I think that the debt problem could be a crack-up boom, a debt crisis, even a debt bubble collapse that we could see. So as much as I think that we must cut rates because we have financed and built asset classes in the last 15 years on super low cost of capital that cannot be sustained at these higher levels of cost of capital, if you cut rates and you blow up your taxes, the world is going to say the dollar and the country has lost its fiscal stability, and we have to look to outside. Again, it will just pressure again the de-dollarization efforts that are already so underway. So we can't go crazy with tax cuts.
You'll kill me with this with this question because I'm going to give you 30 seconds to answer it.
Okay.
In terms of future massive changes in taxes in the United States, how do you advise people to manage their money?
Well, I can tell you for an absolute certainty that I believe that pre-tax deferred retirement buildup in IRAs and 401ks are an absolute tax trap, and that tax policy, mathematically speaking, can only go up from here if we aren't going to actually deal with our domestic social programs and cut benefits. We don't have enough tax revenue to pay for even our baby boomers as they retire en masse by 2030. So we have to deal with that.
Good conversation.
Scary stuff.
Thank you so much for joining us, Rebecca. Rebecca Walser, president of Walser Wealth Management, joining us here.
David Finnerty joins us, Bloomberg FX and rate strategist. Around out of time, but I just wanted to mention briefly, David, Singapore's MAS maintained the slope, width, and center of the currency band. And the MAS said that the core CPI will fall further to around 2% in 2025. And also we had inflation numbers in Tokyo accelerating for a third month in July, up to 2.2% for consumer prices excluding fresh food. That's not all that hot, but it was a little hotter than the 2.1%. So a very basic question, are the kids all right?
At the moment, yes. I mean, if you go to MAS first, core inflation is ticking down. The MS did say they're expected to discernibly drop in Q4 and then even further to 2% in 2025. So they've seen the path. They're liking it. I think the key thing for the market is, would the recent gradual slowing of core CPI, which is what MAS focus on, would it change the exchange rate policies? Because rather than interest rates, they focus on the exchange rate, or a sneer to be exact. And at the moment, the market wasn't sure. At the moment, it's definitely no. In fact, they're signaling they're in no hurry to change it. So if you are bullish on the Singapore dollar, or you want to think of being an outperformer, that is certainly good news. And Tokyo, I think it basically came in line slightly less than expected. Obviously, it's more recent than the national data, because it's this month's data. I think going ahead of BOJ's decision is still elevated. So if they want to hike, and again, that isn't if, the market's certainly thinking they may. If they do hike, they certainly have the argument to back it up.
So the yen has strengthened a bit in recent days. Maybe that has taken a bit of pressure. Is there a call that you'd like to make on the BOJ meeting next week?
I think the call is if they don't hike. I think the market now is looking for a hike. I mean, I think it's about 64% priced in for 10 basis points. So I think if they don't hike now, then I think the market becomes disappointed, and the market tends to penalise you by selling your currency if they're disappointed. So, ironically, even though the BOJ hasn't really done anything, the market likes to get ahead of itself because it's forward thinking. And now I think if the BOJ doesn't deliver, then dollar yen starts heading up higher. Again, you have to see what the Fed says. That's obviously a key component, and what the US data, ISM and payroll data says. But if you say just the BOJ by itself, if it doesn't hike next week, I think dollar yen starts pushing higher. Again, that can reverse quickly, though, if US payroll data was weak.
So let's take a look at overall risk and how the global economy is performing. We had that good economic data out of the United States, but we had weak data in Germany and some warnings in France, and we all know what's happening in China. On balance, should we feel comfortable with the state of play in the global economy or concerned?
I think that there's definitely a slowing in the economy. As you rightly said, the US data yesterday was very strong, and we'll be looking at the data next week to support that. But you said in Germany, the PMI data that came out in Eurozone did disappoint, and obviously China's been disappointing. But again, I think it's a gradual slowdown. No one's expecting a great recession at the moment. I mean, you think the Eurozone economy has picked up. The German economy has picked up. It was in a worse state just a few months ago or last year. So there has been an improvement. So I don't think you can go by just one piece of data and say that's it. You have to look at the trend. I think overall we have a slowing global economy, but one that's not in overall bad shape. It's growing, and we have inflation coming under control. So I think the Goldilocks scenario to some degree still does exist.
And rate cuts in China, a number of them. I mean, loan prime rates, the MLF as well. What's your sense in terms of the strategy that the PBOC is undertaking at this moment?
Well, it certainly seems that they are directing the policy more towards the shorter-term rates, 7-day versus repo rate. But obviously, when the people were looking at the third plenum last week, and if we're honest, no one's really surprised that it didn't come out with a real stimulating growth program, and therefore we're seeing some policy support from monetary policy. At the end of the day, it can't do it all by itself. It does need fiscal support to do some of the heavy lifting, but certainly it seems to be that that they are comfortable easing rates. And I say comfortable because obviously it puts pressure, normally you think, on that it will weaken the yuan. Obviously we saw it rally yesterday, but I think some of that was really more to do with the global unwinding of positions that we've seen this whole week, with obviously the yen being the main beneficiary. I think if US data continues to be strong, I think the dollar yuan will slightly grind higher. But at the moment, just this easing of policy rates does indicate that they are more tolerant, shall we say, of a slightly weaker yuan.
Well, this is a seasonally tough period for equities and other risk assets. If we do see a lot more selling in global equities, would that be positive for the dollar? Would we see, sort of the dollar as a haven play benefit, and throw some of these movements in the yuan and the yen off?
To some degree, yes. I think that does the dollar tend to benefit in risk off? Yes, it does, but then so does the yen, and so does the Swiss franc. So I think the move against the yen gets more muddied, shall we say, by this risk off. I think more the policies of the Fed and BOJ will come to play. But certainly if you're looking at the dollar versus other currencies, say the yuan, or against Asian currencies, then yes, the risk off really should be, in theory, be dollar supportive. And I think what's interesting, you have had this big rally in equities, and it's gone on and on and on and on. And markets historically, at some point, they all correct. They just do. And I'm not saying they crash. I'm just saying they correct. Could be a 20% correction, could be a 15% correction. And all you really had in this, say, looking at S&P 500, is a slight correction in April this year, then it chugged on, and really it's gone from about 4,100 to nearly 5,600, 5,700. So a very big rally. So if earnings next week are weak, I think there's room for that correction to be bigger.
Yeah, it's only been about 5% for the S&P 500. And it's interesting that we've seen the yen strengthen by 5%, the Nikkei correct, the NASDAQ 100 correct. David, thank you. David Finnerty, Bloomberg FX strategist.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.